On today's episode of Flux News, we're going to be talking about the end of the cycle and this regime in oil and how we're going into a fundamental restructuring that could set the tone for the next 5 years for players, participants and risk. We've got hedge funds and rumours about stopping out, losses, gas and power trading and more. And stick around to the end because we're talking about how one of the most standout trades of the year is starting to present itself and something you don't want to be missing out on. So please enjoy. Let's start with the temperature check. Okay, so what do we think, guys?
Pretty warm, nice summer temperature.
Dissipating was what we...
Dissipating, but still warm.
Yeah.
But definitely off the like red hot cycle that we've been on.
Couldn't quite find the word for dissipating heat.
No.
It is dissipating and heat
Okay,
transfer, yeah.
You're a chemical engineer, aren't you?
Okay,
Yeah.
so dissipating.
So it's just, yeah, I guess just the general thing is like when you have a really strong market that's on fire, spot market in particular, it, you know, at some point has to get priced in, right? So we priced in like, what, one kind of 30 differentials, $1.30 in North Sea, which is a very strong physical differential. I think we had 150 in Dubai. And then it's kind of like eased off since, which is what you'd expect, right? To go to like beyond there, you're talking like 2022 levels for crude, which is like the all-time biggest bull market ever. So it kind of makes sense. You've got that in the spot market and you've got the rest of the market kind of still unsure, right? So as in like, I think we've reached those healthy levels in the front time spread, Brent spread, which is expiring in a couple of days time. And we've kind of reached that like nice level that seems to be reflecting strong reversal from like the peak bearish times couple of weeks ago. And so we are where we are, but like, I wouldn't say it's like a wait and see. I still think we're in a bull market, right? That's kind of how we define it.
Yeah, I guess it's just people have taken their foot off the gas a bit, and you might know better than me, but in terms of like the dated strength that was there last week and the last month in the Dubai strength that's there, is it just a case of like in Dubai, that kind of buying spree, the guys who are buying have kind of got what they needed and there's no
This
one
is in the Dubai stuff.
Yeah.
Yeah, well,
and there's no one really behind them as aggressive, so it's just like...
Yeah, I mean, the way we're hypothesizing here because it's hard to really know, obviously, but it did look very much like the Chinese coming in to buy on the float lower flat price. We've got confirmation that their imports increased in March at least. I think we'll definitely see that come up again in April. But again, it's the oil traders who have so much to buy. When they do that, they have to have an outlet, right? Like a VTOL or a Trafigura. They're not going to store 60 million barrels of oil in a backwardated market, right?
Yeah.
They're going to be having somewhere to send it. So I think, yeah, once that buying spree was done, it was like, okay, what next? But I think more than that, it's continuing to buy at that level on such an uncertain backdrop for OPEC, right? And that's going to be a big theme, I guess, of topic today. But no, that would be more my reasoning. It was turning to the North Sea, which was like, well, hang on, if Dubai's going to be so strong, that's might be temporary because of China, whatever. But the refinery margins, like our refinery margin, I don't think we've got it up there. But
I've got it up on my screen. We're just, for the front European margin, we're just over $8 this morning.
Yeah, see, that's ridiculously high, right? If you chuck that up on the screen, this is just a benchmark, right? Like we take weightings of all the product cracks, so the refined products versus Brent, and we try and weight them according to how we think, like what we think is reasonable, right? This is not an exact science because there's so many different refineries with so many different yields, but this is a good estimation, right? And it's sky high. I mean, like we're looking at like, I guess if you zoomed out, way like on the historical high side, and no real reason for it, right? Because we have had the flat price rally, and if the outright price is high, you would expect that kind of like the product cracks, which are a differential to the outright price or the crude outright price, to slow down, but they haven't. I mean, it just keeps going. So the refiners are the buyers of crude to produce those products that are making such a profit. And so why would they slow down? So that is still, I mean, a very, very bullish thing. You can't deny.
Yeah.
Anything else? General like temperature of the market. I mean, people seem a bit more risk on, I would say.
Yeah. And like there's been good move in gasoline, which has also caused a okay move in naphtha. Fuel's still pretty strong.
So it's been a little less taboo to be bullish now.
Yeah.
If you remember a couple of weeks ago, you can't be bullish in a tariff environment and a US recession. And now that's like, It's dying out,
It
right?
doesn't really feel like anyone gives a shit.
No. Yeah.
I was going to say CFTC from Monday shows that risk on attitude come back. Net positioning from money managers in Brent's up 30%. It's up 60% in WTI. People are putting that risk back on when we saw some pretty hesitant weeks in the past few.
And we'll get to that as well. I think probably the last thing on this is when people have been talking a bearish game and all the analysts, the banks and the the energy aspects, the cappers have been saying it's bearish now and they've got to stick to that bearish narrative. The price action would suggest the complete opposite, right? So what's the justification? Well, it was interesting to see JP Morgan, I think last night this morning with their view on
Was it the same one this morning?
the time structure thing. So they were saying basically it's backwardated time spreads in Brent for a few months, and then it goes contango for next year. And so you've got this, like, if you look at the time spreads on a graph, it's like a smile. So it's basically just saying is disjointed, right? The long-term surplus argument, which seems like pretty concrete consensus, but then you've got really strong time spreads in the front, and everyone's saying, oh yeah, some of them aren't, didn't you know?
Yeah.
No, you didn't know. You're changing your narrative now. So I think trying to make sense of something that's confusing analysts is kind of what's going on now. But anyway, that's
But
kind
just
of
going off what you said, the energy aspects have released a similar thing where they have showed their CTA volatility model. Funds are very, very short in the front, but because of the disappointing macro data from the States especially, they're putting more short positions further down the curve. So there's kind of a red flag to keep an eye on the big macro releases this week from the US, because that could kind of pull the rug out the front a little. That's what this was saying to me anyway.
it's good. Little insight before the hedge fund what? Let's
Oh, shoot.
now,
Sorry.
let's now talk about the herd mentality. Okay, so this is when we talk about what we think the main headlines or themes that are driving the herd or the consensus trading, because ultimately everyone bands together and buys or sells. That causes the market direction ultimately. So what do we think is causing it right now?
Feels like OPEC is sort of front and center. And I guess for the viewers, so the key OPEC things that were said were, so Kazakhstan said that they would prioritize their national interest ahead of OPEC quotas, which the market digested as them. I mean, what was that? Them being a bit kind of like renegade attitude and being like, if we want to produce, we'll produce kind of thing.
Yeah, I mean, it does seem like the members, like, they have their arguments behind the scenes and they kind of use the media to kind of make their point back to each other, but publicly, which is quite damaging, right? I mean, this is the type of thing where angers people a lot, but that is their weapon to use. It's how you punch above your weight using media. That's what I say all the time, right? So I think that's all that is. It's you've been overproducing, you're not sticking to your quotas. They say, well, we don't care. Like, we need to do this. We need to protect our natural interest. And we'll say that. And you're right, though. It's a little bit renegade attitude, and it's compounding, right? You've got ADNOC very, very publicly were doing that last year or even the year before. And it's probably gaining weight that people aren't interested in doing that. But I guess what we got to talk about this time is, again, when you throw a headline in, I don't know if you guys ever saw Succession, that TV show, but it was really interesting because the funeral where the dad dies is massive spoiler alert shit. There's a funeral, and the point is that there's some really bad news for a company to release, and saying, oh, it's a funeral, like, this is the best time to release it because everyone's going to be televising this funeral. Everyone's going to be talking about this funeral. Oh yeah, by the way, our results are really bad. It was interesting that in the midst of this crisis, tariff crisis, as big of a news as you can get, the whole world talking about it, OPEC are like, oh, we're producing more, which is really, like, everyone was so unexpected. And I was, really surprised by it. We'll never know, but I guess knowing how we know OPEC operate, they're very, behind the scenes, talking, strategizing. Al Mohana, I think it is, on his book, forget what it's called now, Oil Leaders, he absolutely went on about how there's a lot of thought about how to present their case to the world and to journalists, and they do campaigns and they want to capture sentiment because they believe that's just as important as the physical. So they absolutely know what they're doing when they release something publicly. And it just struck me as being so resistant to production increases for so long. We've got I think the oil from 34, 35 at the peak in 2016 down to something like 28 million barrels per day now. That is a huge decrease, and it's such a stubborn decrease because all the while we had wars during that period, we had complete outages of oil, we had depleted stocks, and they still cut.
Yeah.
So why produce more?
And
now?
like a much higher flat price environment.
And a much higher flat price environment. I do think they got themselves stuck there. Like they thought, oh, it's financialization, that's why it's whipping around. It will still go up to 150, 200.
Yeah. And
it never did, but you're then because it goes lower, you can't produce more now because then everyone's going to sell even more. So rather than biting the bullet, they just held out for a long time. But why now then? So it does strike me that, you know, the only one to have had this behind the scenes talk is Trump. The only one I can think of who's actually going to do that because he actually has something to bargain with, which is arms sales and things like that, which maybe other presidents haven't wanted to do. So, I mean, that's what it seemed like to me because it suddenly be so adamant that not only are they going to produce more, they're going to produce more in a sell-off. And now they're saying they're going to produce 400,000 barrels per day more next meeting, right, Martha?
Well, that's the rumor. It's not, well, obviously it's not confirmed until the meeting, but it seems almost like a response to the kind of open secret of overproduction and that the countries inside of OPEC aren't really following the internal compliance. And I think the way the market has processed it kind of confirms that this is an increase on paper rather than in the physical oil barrels. Wait, no.
Yeah. So what you're saying is in the signaling is an increase. It's not actually, hasn't happened.
I think there's been so much in the media now that there hasn't been previously saying that there's this overproduction from these three countries, especially say Kazakhstan, the UAE and Iraq, that now this is kind of being reflected in the lack of response in the market, you could say.
Yeah, okay. I mean, when you say it has not been confirmed, I obviously understand the point, but with them,
I know.
It's a leaked headline. It's always the same thing. They're testing the market. And for the market to rally during that release, it's either been ignored or it's people only just catching up to the thinking now.
Yeah.
And again, we showed the margins. I mean, I can't go on about how much that is such a bullish indicator. The physical diffs are so bullish in crude. That is a bull market, full stop. So I think that's probably what they're looking at as well, being like the market can take our oil.
Yeah.
But yeah, the flat price might not be reflecting it quite yet or whether it does or not. But then on the flip side, you've probably got people still willing to bet that, you know, a price war or at least more willing production increases from Saudis and OPEC in general has to mean a lower flat price, right? I mean, it's quite hard to like slag them off for thinking that.
Yeah, I think so. One thing I was going to ask was whether I was thinking about like the timing of the headlines in the week. Do you think they see things like high sulfur fuel being strong? Like I know Brent Dubai has been weak for a while, but things like, you know, all-time highs on high sulfur fuel, like refinery margins super high. Do you think they then, like you said, do you think they then see that as like a good time to basically be like, you know, there's going to be demand for this crude. Right? There's going to be demand for this crude. Like, is this a good time to be like ramping up production, basically?
Yeah, I mean, 100%, right? Well, what I do know is that, you know, I've done it myself. I've gone in a couple of times to the OPEC headquarters and presented more about financial side and talk about how Brent Dubai is positioned and how, you know, what's driving the market, be it gasoline one time or whatever. They do that very regularly. This is like, I don't know, at least once every couple of months, they get in all the biggest firms in the industry and just say, present to us about what you think. And everyone wants to do it because they want to be seen with OPEC and seen as like influencers in the market. And man, they go into serious detail. I mean, I sat there once where it was a whole row of maybe like 15, maybe more actually, 20 companies. And they would get up and each speak for half an hour at a time or 15 minutes at a time, and everyone would overrun into half an hour to get their bit. Going into like serious detail. And I guess their thinking is like, if collectively I get my thinking across, it's like any kind of influencing, right? Then, or A, I'm given respect, and B, they might think the way I do and help my positioning or whatever else. So no, I don't just think that. I know that the most serious detail is presented to them at all times, right? And then they have, I wouldn't say that was a public one. That was like more of the one I was there was quite a big one. And then they have an even more secret one, which is like just a select few analysts, and they go and like go even deeper. So everything we're aware of, they're aware of probably even more, right? Because it's like every single research agency, every single bank, every single trade house, every single prop firm, whatever, will be presenting some form of argument to them. So I think you're right. It's worth noting that, because sometimes you think, oh, all they care about is this, and they're, no, come on, they know everything.
I was going to say, for like, I didn't even quite realize like how like granular it gets to them. And I guess like if all you see on the headlines is them just kind of spouting off stuff and it sounds like clickbait,
Yeah.
you would probably be forgiven for thinking that it's like 10 guys in a room just being like, what should we do?
Well, it probably is that at the end of the day.
Yeah.
At the final
Yeah,
part.
but it's probably not that like well telegraphed that they have that level of like information poured into them all the
insight.
time.
Yeah, it still comes down, but that's the funny thing. Like you hear about these funds who have 50 weather analysts and PhDs and all this, and it's like, mate, they have a computer, they have a screen, they have like a trading account, and they're buying and selling.
Yeah.
At the end of the day, it comes down to very simple like decisions, and you can overthink these things so much. But as you said, like one or two proxies for demand or whatever, they're going to look at that, and then what they want to see out there is people believing in the narrative. I think that's the most important thing. Like, this is our stance, this is how we want to see it, this is how we want to play it. Now we need to convince everyone to see it the same way. And again, the book I'm talking about, the oil leaders, Mahana, he was very much talking about that. Like, when you go on a campaign, you speak to journalists, then you speak to the analysts who are influential, and you explain to them, this is what we think, this is why. Go and write a piece about it.
Yep.
And of course they do, because they want to look good and whatever else. And that tends to be how the circle goes. Sorry, the trajectory goes. But then the problem is when people stop caring. And I think you never want to be like, an influencer never wants to be out of the headlines, right? So as soon as you're out of the headlines, you're irrelevant. So I think, if anything, like OPEC's been fighting its way back in recently, being like, no, we're important again, because for the first 3 months of the year, it was all Trump.
Yeah.
Right. And it's quite hard to get the narrative back. So you have to kind of do something unexpected. So maybe that's what's going on right now, like getting a bit more like, no, we're bringing about production. That shocked you, didn't it? And, look, what's happening next? And don't forget the Iran stuff, right? I mean, that's still not many eyes on that. We've talked about it on the podcast, but people aren't really talking about that. If Iran does make a deal with the US, that does translate to more reliable crude into the export market, which is definitely going to impact on the Dubai benchmark. I have some particular thoughts about, we haven't talked about any trades yet because we're waffling on, but I think the proxy for OPEC decision-making on crude is like 100% Brent Dubai. Again, we've said that already on the podcast. And actually, Vincent, who was Geek in the seat a few weeks ago, was talking about Q4 Brent Dubai. Whether it's Q4 or whatever, Brent Dubai has been in like a perpetual state for about 4 or 5 years, just non-stop, like falling trajectory. I was speaking to a guy who's no longer junior, but when he arrived in 2022, he was a junior on the Dubai desk. And he's like, I had never seen the market go up in Brent Dubai. It was just +6 all the way down to -2, -250. And it had just been like stuck there because a negative Brent Dubai is, OPEC in a state of really cut production and strong. That's the Dubai leg, which is the one below. And then Brent, obviously a lot weaker. So negative Brent Dubai. But historically, like zooming out like last 40 years, that is not the level it should be. So when you say there's a fundamental change into the way OPEC are thinking now, like was essentially what we're saying, and bringing back this supply from 28, 29, all the way back to potentially in the 30s, the one differential that is completely out of whack and needs to normalize is that Brent Dubai. And you can still buy it at negative levels. I mean, that's it there, right? That's the rolling month M1. So that's May right now is -57. It's rallied from like what, -160, -170 in only like a week, which is a huge move, but it's got a lot longer to go and people are starting to pile into that. So we'll probably go more into that about why that's so important. But I think for sure, just to cap off the herd mentality, everyone's going to be looking at those headlines. And when's the meeting?
Yes, the meeting's on the 5th. So prior to that, expect like lots of more kind of breadcrumbing information, as you mentioned earlier, into the media and their favorite kind of oil influencers that they have. So keep an eye out on X. And then on the 5th, it's just going to dominate everything in the market. So definitely, yeah.
So would you, like, on the day of a meeting, you just basically chuck on like the live reporting is in most news outlets, right?
Yeah. Is this one online? Is this online?
I don't know, but usually what you have is like journalists being like, look, everyone knows an OPEC's meeting going on. We'll let you know if we hear anything. And the delegates might sometimes come out and give little snippets, right?
Yeah.
And I know that Javier Blas at Bloomberg was a big one for doing this. And then he got banned.
Yes.
Because I can't actually remember.
I mean, I think you just said something there.
Yeah, it's something they didn't like. Yeah, but the point is that usually they stand outside the physical headquarters and kind of feed stuff as they're hearing. So maybe we'll expect more of that. It's quite an important meeting though, right? Because if they do follow through this 400,000 barrels a day, it may not cause, but again, we don't think it's going to cause like a shock impact on flat price, but certainly the Brent Dubai differential and things like that. Anyway, we'll keep talking more detail later on with trades and stuff. But given we've been talking about all the physical side and OPEC, I think it's time to talk with the publishing arm, the officials. Ed, Will, hi guys. So do you want to talk about kind of following on from what we're talking about with OPEC and the physical? Is that what you're going to talk about today?
Yeah, exactly. So really exciting week ahead with the OPEC meeting on the 5th of May. The rumours we're hearing anyway are similar to what you were saying, 400 KBD coming back, additional voluntary cut unwind. So that mirrors the most recent set of unwinds. The interesting thing to follow here will be the compensation schedule and any adjustments that are made there. So the overproduction that I think a lot of the market is pretty focused on has led to a number of OPEC members being issued with additional compensatory cuts to make up for that overproduction. So if we look at the table released on the 16th of April on my screen at the moment, we can see in May that the total compensatory cuts are actually like 378,000. It's 378 KBD. So that's a good chunk of that unwind. So yeah, be interesting to see any adjustments made there. I mean, what are your thoughts on the?
Yeah, well, it's kind of the bad boys of the group again getting punished in this way, because you get this unwind of the additional voluntary cuts for the likes of Iraq, Kazakhstan, for instance. But then the compensation schedule means that they don't actually get to pump anything more, because they have to make
If
up
they stick to it.
if they stick to it, because they're supposed to make up for what they've already overproduced.
Yeah.
So in that respect, the impact won't be as significant as perhaps the market might fear.
And interestingly here as well, Saudi Arabia, no compensation schedule. I mean, they've been pretty compliant as far as our data suggests. So yeah, any more unwind from Saudi Arabia will likely materialize in more barrels coming on the market. Last meeting, I think they got 160 KBD unwind. So looking for further unwind from them.
What I'm hearing is as well that the Saudis are getting increasingly frustrated with the lack of compliance from other OPEC members. So, these Kazakhstans, Iraqs, etc. Their patience is wearing thin.
Yeah, well, I mean, it makes sense. I mean, Saudi as well, I think a big motivator as well as the kind of Trump diplomatic aspect is also national debt, right? So in 2024, their Saudi deficit was about 2.8% of GDP, and they're expecting it to rise to 3% in 2025. And let's not forget that Saudi get pretty preferential offerings. Like just the fact that they're able to pump so much crude to pay off their debt often means that their issuances are pretty good and pretty sought after. But that's only possible if you do eventually,
You're actually pumping the crude you need
to pay off. So yeah, I think a little bit more unwind from them would be likely.
Yeah, but the window as well, because that's kind of the proxy for it. As Greg was saying earlier, the physical demand and the spot market tells you really who's buying, where it's actually going.
Yeah.
But in the last week, both the Dubai and North Sea windows have really come off massively in terms of the physical diff and the physical premium. So the Dubai physical premium, as we can look at now on our chart here, in the last few sessions has come down extremely hard. It came down from $1.75 per barrel just 2 sessions ago on Thursday to only 114 yesterday. And that's really the absence of a major buyer as Vitor stepped back. China's still selling pretty hard. And that has seen the physical premium drop very, very rapidly. And equally in the North Sea, we had Traffic last week came in and bought 10 cargoes in 3 sessions. Yeah. And then as soon as they disappear on Friday, it drops. And then it drops again yesterday down to only 48 cents by calculation. So yeah, both bids are coming off pretty hard.
Yeah, definitely.
That's what I was going to ask. So yeah, thanks for following up on that, and thanks for embracing the summer casual nature, Ed. You look great.
Pretty warm there.
But that's awesome. The only thing I would add is when you talk about the spot curve, or the spot market, there's also a spot curve, right? This is getting a little more nuanced, but you have the whole point of the time spreads in the future is to indicate the future physical differentials, right? And it's a function of storage as well. But the point is that I hear your point. You say the Dubai is starting to weaken. I think Dubai is definitely the uncertain one. And the Dubai time spread starting to pull back, which allows Brent Dubai to be elevated, which is a proxy, again, from the two regions, Brent versus Dubai. That all makes sense. And I think that might be might be an indication of a long-term trend and certainly a restructuring. But the North Sea one, I would slightly question because we lagged Dubai on the way up. And yes, one particular week of spot crude pricing has now weakened. But the thing is, you can actually get from the forward curve. And again, you can look at this on Flux. I actually don't know where else you can see it. But ultimately, when you look at the CFDs, so the CFDs is the dated Brent market on a weekly basis at the very spot of the market. This is like as spot as you can get. But what you can do by looking at the time spreads week on week on week, very granular, is you get an implied physical differential about where the physical direct differential will likely be, or at least where the market expects it to be when it gets into the actual spot market. And that is indicating a rebound once again up towards close to $1. And it's certainly how traders are positioned in the North Sea. So I would say that's a slight temporary dip. And I would almost say, look at the Dubai spot market as an indication of what's going on with OPEC. And I think you're very spot on in the way you're thinking about it there. But the dated Brent right now, I think you've got to look at it more to do with refinery margins. I mean, you really do get a very sensitive market. They can wake up in the morning, see that margins on the back of yesterday has gone up, $1 per barrel, let's say, and they will go in 10 minutes later and start buying derivatives in dated Brent to lock in that margin. It really does transfer. It's a very sensitive market to prompt refinery margins. So that's the only thing I would say. It's almost like divorce, two different markets. One's a fundamental market, one's looking at the future of production market. It's an interesting dynamic at play. But in general, thanks guys. And I think you guys in particular are going to be really important in the next week as we head towards the OPEC meeting, kind of more our publishing arm. So videos to come, some insight to come, hopefully a bit of Jorge as well out in Dubai. So keep us in touch and thanks guys. Okay, now to the hedge fund watch. Okay, this is the section where we want to look at the actual kind of hedge fund activity and how we think they're positioned and how we think they're making or losing money. So who wants to start here? Martha, you want to?
I mean, Onderon's been the biggest name in the headlines. The headline being...
Well, for a long time, right? He's the commodity pin-up boy.
I meant, in terms of recent losses. I think he's the headline, oh my God, it's great when everything's bullish. But this past year, it's been 52% of the losses this year after April. The headline from Bloomberg says.
Yeah, I think, he's an oil guy by nature. He's been in plenty of books and, people know a lot about him. But I actually think what he was signaling last year was more long copper and long cocoa.
Yeah, cocoa, copper and oil were here.
Okay, those are the big trades last year. So I think more what that's indicative of, and we've heard plenty more, it's just these funds that came in, not necessarily on, he's been there for a while, but new funds that came in to be long commodities, right? Commodity super cycle 2.0, energy prices going to skyrocket. These guys are really getting hit, right? So like in the power and gas market, we've heard plenty as well, right?
Yeah, so if we get up on the screen this COT chart looking at investment funds in TTF, we can see that levels have been really, really high in the net positioning. Levels have been really, really high throughout like the last half of 2024, essentially. And every time we weren't getting those crazy price spikes that we were expecting because the media were pushing the storage story that we weren't going to get enough storage, we're going to have this bad winter. And so funds were positioned very, very long. And when that didn't happen, we have kind of seen that sell off since. The graph.
Just quickly, our Zug team who does power and gas, they start up some podcasts as well. And I think it's Hope Dies Last was the podcast I did with Mirko, who's the lead out there, co-lead out there. We talked for an hour about this and it's super fascinating. Yeah, as you say, the market was positioned very, very long TTF and gas, expecting the storage situation to be a disaster, not enough storage available. Sorry, not enough gas available to fill the storage that's mandated now by Europe. There wasn't the expected inflows from LNG, which actually we have seen now. There were so many bull factors that the market really thought they were going to have their heyday, and the hedge funds like, this is what we came in for. But ultimately, one message from Trump about, a ceasefire completely took them unawares. And since then, you've actually been, funnily enough, what's come after that is no real change to the Russia situation, yet loads of fundamentally bearish news, like way more LNG supply than people could have thought from the US, showing you how much incremental supply they can increase. And, I guess weather and bits and pieces as well. So that's killed that market really, right? Like people are really, really hurting. We've heard banks are losing a lot. And again, this thing about funds and banks, we talk about oil predominantly, but more and more so energy, but people look at it like energy and commodities. So you can have all these losses or gains and it all gets blended in, right? Like even the trade houses in 2022, when they were shouting about their huge wins, at least half of that was power and gas that year. Like, they don't really, they're not going to go into granular detail. But on the flip side, when there's huge losses, you don't actually know the extent of it because other areas of the business will kind of
make up for it
to some extent. So when we hear that people haven't done as well this year, and as that comes out more and more, that's actually a sign that quite a lot was lost in the gas, I would say, and all that.
It really is coming out though. We've seen some trade houses lose so much money, they've been forced by risk to close their positions in power and gas for the rest of the year.
There's plenty of rumors that's coming around about that. People stopping out, management saying, look, I don't care, we just have to stop. Prop firms, the same thing. I was expecting more like basically blow-ups, like big liquidating, like firms actually going under. I don't think I've heard any.
Do you think it's a bit too early to tell on that? Do you think they're sort of very well capitalized and
given the back of so many good years? That's actually quite possible.
Because I was going to say, most of these funds who we're now hearing about losses, they've had some good years, right? They kind of really piled into this cycle where there was a lot of money to be made in gas and power in the last 5 years, and I mean they were making billions and per quarter, and then now it's all kind of unraveling. So I guess maybe a bit early to tell, but
that's a very good point. I mean, exactly. And I think the other thing about losing money is an obvious thing to say, but when you get margin called, right, that's the big capital event. You've got margin calls, you need to find cash from somewhere to fund a position. Now that we've heard of in the physical side quite a lot in 2022 and beyond, because there's such volatility. They've got these enormous hedges on, and this is actually what killed even utilities who did hedge, or some who didn't and got genuinely blown up. But from the margin perspective, that's funding your position. You can find people to short-term fill the gap. Be like, look, come on, just give me some financing so I can position, keep this hedge on. It's against the physical. It'll be fine in the end. Don't get me wrong, it's hard to do. No one wants to just give free money. So consortiums need to be built. I think Trafigura had that, and other firms, got very close to the wire from a capital perspective. But as you say, they then made so much money in the years gone by that they're not going to get into that margin call situation. But when you lose real money, i.e. on a position, not a hedge, a real speculative position, you're not getting that money back unless you keep gambling, right? So that is what hurts more. But in a weird way, it goes under the radar because it's not like you don't have the capital to fund your position. It's just you don't have the profits. And so how does that materialize itself? Not going to be instantaneous necessarily. So I think that's a fair point. So we could start seeing it out on the news basically more and more.
Yeah, for sure.
So what else is there to say? Anything else on the hedge funds? I guess more like the positioning. So you mentioned already, Martha, about Energy Aspects publicizing some of the breakdown of hedge funds. And we've got our own one as well, showing the CTAs are still short, right? I mean, we talked about that last week, and that's a very big deal.
Yeah, so we have seen an uptick this week, but we're still in the minuses. We've been seeing this kind of congestion area, if we get the chart up, around the minus 100K level for the total combined positioning of the select futures we look at. So it's ticking up, but there's definitely room for this to kind of blow up and us see the closure of some short positions from these CTAs. And that's what we see the big movement in price often. That's when you think of the CTAs as taking up a chunk of the market positioning, when that moves, we can see a much bigger movement in price.
Absolutely, but I guess it's interesting just how much movement there can be from such a generic flow, right? I mean, we're just literally talking buying because it's going bid, or offer because it's going offered, and it's the time range that's different, or the price range actually. It's you've gone up from 58 to 65 and they're still short. That's a $7 move to not buy into, which shows you how like the kind of depth of their like ranges that they're looking at. But if that flips, that is seriously bullish. And we did say that last week. And actually, to be honest with you, I was expecting it in the last couple of days. It was 67.50 in the front, something like that. I was like, getting into Brent expiry, given Brent is looking very strong in the underlying, that's going to go. It still has echoes of that. The only thing I would say is we're still impacted by the financial markets overall, and oil is still impacted by macro markets overall. So it's not the greatest situation right now. Of course, everyone knows this, but whenever there's like these kind of disputes with China and all that, it does find its way.
All of a sudden, everyone starts to get a bit shaky, and then you have like the OPEC stuff as well, and like say China starting, it just felt like all of a sudden the narrative kind of like pivoted a little bit, and then everyone starts to get a little bit shaky. Yeah, I just think in general it's a bad trade right now, the flat price. Like you could have caught the move down, you could have caught the move up because of a dead cat bounce and actually looking at the underlying and all the rest of it. But right now, I just think if you're bearish, why are you bearish? OPEC, right? Like you just said, or recessionary. Okay, there's two ways to reflect that trade. By far and away, the best one's Brent to buy. It's completely undervalued. You can buy it at a negative price level, which is insane historically. And it's so positioned for, if there's going to be more supply, it's going to come from OPEC, Brent to buy full stop. It's as bearish. We've had all the bearish Brent to buy news you can have in the world. Strong positive fuel cracks, strong distillate cracks with peak cut OPEC. Yeah. So it can't get any worse than it is. Yeah. Okay, I've made that point. But if you think, no, it's recessionary, it's demand focused. Okay, we'll sell fuel and sell naphtha because those are waste products and they're recessionary. And shipping and plastic production has to go down in recession markets. And those two cracks, that is in the levels versus Brent, are very high. So short those. You shouldn't short flat price yet, purely on the basis of the net positioning, purely on the basis of the uncertainty. And when I think those things have to go first. Yeah. And you've got strong refinery margins. Yeah, I was going to say, given what's been holding it up has been like margins have been really good. It doesn't feel like that's the right contract to sell. And this is why we love the swap contracts and the differentials that we trade in. It gives you a much nicer way of expressing a view on what's going on. Like flat price, there's just so much noise at the moment. Yeah. You might have everything right, but then all of a sudden China says, we've never spoken to the US about this. And it's like, you can't plan for that. No, you can't. But I guess we're speaking about hedge funds at the moment, and I guess they still aren't really in the swap markets that much. We see them in Brent Dubai, we see them in DFLs. So these are two crude related contracts. But they could do more of it because of exactly what you're saying. So if you're a hedge fund right now and you're discretionary, you're saying I have to trade the outright because in order to get the returns, I have to trade that contract. Yeah, you have to participate in something that moves that much. It's a very difficult position to be. You could be bullish or bearish legitimately. I can see the arguments for both. I don't like the the bearish argument, but I absolutely see the logic in it. I just think there's better ways to reflect it. On the flip side, to be bullish, what would you hold to be bullish though? I mean, being bullish flat price as well is a little bit risky as well. Yeah, but then from a physical crude perspective, you'd probably rather be long like dated Brent spreads or Brent time spreads. Well, the Brent times have been good liquidity, and they've been weirdly held down. So they'd rallied, they were so strong on the initial move down to 58 on Brent, and WTI time spreads and Brent time spreads have really performed. But now, as we get close to the expiry of the front, it's almost like people are believing this JP Morgan thing, right? They're saying, okay, it's strong right now, but it's going to get weak. So everyone's selling kind of Aug-Sep onwards. Like the time spreads really suffered in the last few days in particular, but the front has just stayed like, I don't give a fuck, I'm staying here and I'm going to price strong. So I would have agreed with you, but now I'm thinking, I think those time spreads are undervalued now. Right. Because they're just really under this pressure because, OPEC on the 5th of May say we're producing more in June, not May, in June. Sorry, not in July or August, in June. And you're trading a July-Aug time spread. You're probably thinking it's 3 months away. That's plenty of time for oil to get back on. I just can't take the risk being long it. But then you've got the refinery margins again. Yeah. So it's in a way, maybe the best bullish crude trade is like selling the refinery margin because you get a long position from the crude. Selling the product cracks or something. Yeah, and if you really think production, but that would just be pretty. That doesn't feel like the right thing to do either.
you're pretty screwed either way. I think if you're looking for this like bang outright position, I think it all comes back to the Brent Dubai now. It's the only one that kind of, because if you will get the refinery margin supporting the local market in Brent, will help the Brent leg of the Brent Dubai as well be bullish.
Yeah.
So yeah. But anyway, in a nutshell, eyes have got to be on this, right, Martha? I mean, CTA positioning, flipping long.
Yes, the CTA positioning is really vital now. I mean, that takes up such a huge amount of the market, and watching that net positioning change you can do on Flux Live. And we also publish the long-term view as seen in the line chart in our weekly free CFTC review.
Okay, so you can do that every day, get updates. I guess the report on Friday will show, from the CFTC, will show Tuesday's positioning or positioning changing in the hedge funds as of Tuesday. That will give you some indication. But generally speaking, I guess you're just price action in the expiry tomorrow, the day after tomorrow. Tomorrow is, I think that's a good indication, because just to finish that point, if there's so much length in the front of the time spreads, I said this last week, you've got basically an entire industry of traders, like North Sea traders, who carry huge volume, like disproportionately huge amount of volume. So they've taken on, if they're long, they've taken on all the hedge fund roles. They've taken on everyone's roles who's rolled their position in Brent from June into July. So now they hold this time spread. So what does that mean? Well, when the June leg expires in Brent expiry, that's going to disappear, right? That's going to settle to a cash settled price, and that could be financially settled, or they could convert it to the physical, and it keeps on going to the spot market. But that leaves them short July flat price. So a time spread, long June, short July. As June prices off, they're now short July. So that means they've got to buy that back to be flat. So what they do is, that's why at 10:30, 12:30, 2:30, 4:30, 7:30 tomorrow, there's special contracts that the exchanges have created in order to get liquidity for those time periods, because those are the windows when Brent is expiring. It expires like periodically over the day. So what you're going to get is a huge amount of buy volume in the July contracts for people to hedge out of their short left over from this time spread. But the thing is, by buying that, it also helps the price of June be stronger. So it's like weirdly like ammunition almost, like all that buying flow is probably going to create a stronger June price. And then the CTAs are in the background, probably not programmed to think about expiry, right? So ultimately, there's a lot of buying flow, is what I'm saying, to come into the outright flat price tomorrow. I think we've had a bit of bearish news the last couple of days. I'm going to take the view that there's like too much buying flow coming in the next couple of days that to basically resist it, and it could trigger a decent move here. Okay, so we've talked a lot, but we have also talked about a lot of trade ideas. In summary, what are the ones we're looking at?
Well, definitely long Brent Dubai.
Yeah, we'll get to more of that.
But I think as well, what we sort of suggested, better ways of expressing views than trading just the outright price. We said, if people want to express views around a recession, shorting fuel, naphtha cracks, maybe even a gas oil crack. These kind of proxies for these
for the recessionary, if you're bearish on that basis.
Yeah. In terms of a bullish view on crude, buying time spreads.
July,
August, Sep onwards.
Yeah. I'd say if you do want to be trading the outright price, which we all do, and like people are not going to stop trading it just because it doesn't look like the greatest environment right now. I think we just said the Brent expiry. You've got to be aware of that out there, right? If you're a retail trader or even the investing world and all that, you've got to be aware of these dynamics, because this is a hell of a lot of flow going in, and people seem to know more about options expiry than they do the actual expiry. Which options expiry is also an important thing for liquidity events. But anyway, expecting that flow. Okay, what if it doesn't rise? Well, that you've had an incredible amount of buy volume go in and it not move up. That is pretty bearish. So you can either trade momentum or use it as a signal to flip short, or there's still stuff to do, and more information basically is better, and you can trade off the back of it. And I think that's pretty well summarized for now. Okay, so let's look at where people have made money in the last week. This is the gold rush. Martha, what's the key contract people have made money on?
I think this week it's got to be gasoline, looking at, gasoline in all regions has rallied. We've seen some strength in the past week or two, which has been, really indicative of kind of physical strength as well. We've seen Mexican NOCs buying over in Asia, which has supported the Sing 92 benchmark, which is the Asian benchmark for gasoline. In Europe, we've had a refinery down in France, more refinery issues to come out of this electricity issue in Spain that we saw yesterday, well, in the whole Iberican Peninsula, which we have seen some refineries suffer from. And then from that, it takes the refinery quite a long time to get back up and running, which you can start receiving crude straight away, but you can't start making products straight away because, things take time in the process engineering and stuff. So that will probably take another day to get everything up and running fully.
Yeah.
So that's something to keep an eye on in the future as well, just for European gasoline production. Yeah. And then in the States, we saw a pretty good draw in the EIA stocks last week, which was good for gasoline, especially, was very reactive to it. And we've got levels back in rubber, which is the RBOB US gasoline differential to Brent. We've got strong levels now, but like they were pre-tariff.
Yeah, I think, look, you summarized it well. I mean, a few weeks back, we were thinking, actually, if anything, we were just talking about EBOB, the little spurts of strength. As you said, all regions strong, unilaterally strong in gasoline. There's got to be something else going on other than just positioning, and the fundamentals have been strong, like you say, Martha. But I think the thing you've just highlighted there as you were talking is, summer strength is a theme in gasoline markets, and people tend to expect it. And we've talked about this before. But we also started to talk about outages, and that looks like it's starting to happen. Yeah. So what's the first? Well, you just talked about a refinery going down. We just had Germany and Spain.
Portugal and Spain. Power?
Yeah.
Power out in, the whole of Spain. And bits of Portugal.
Power outage.
And I think only as of last night, it was like 20% was back online in Spain.
Yeah. Well, this is it. Those in you think, okay, power markets, gas markets, and actually, weirdly, they didn't react that much, I would say, relative to what you'd expect and things like carbon and all that. But refineries go down. They rely on power. So refineries going down, it might be short term, but it's indicative of, heavily reliant on a power system. And if we get the summer heat waves and things like that we've seen in the past, this is a market very vulnerable to refinery outages, particularly in gasoline, right?
Yeah, I think even with the more extreme weather events, I don't know if yesterday was like a solar flare or something like that, these kind of unpredictable acts of God that can just absolutely disrupt the network. I think it's really important to be hedged and really important to know kind of where positioning it is at all times to see if it can, short covering and the prices could fly. So that's a reason to always keep an eye on the positioning, both in the CFTC and in the Onyx data.
Yeah, I think if you talk to the industry, no one wants to be short Q3 refined product versus Brent. So we were talking about that almost tongue in cheek about a way to be long Brent, but that's not going to happen in the industry. If they're going to short these cracks, as we call them, they're going to do it post summer or post summer rally. And I think, to be fair, from a trade expression point of view, if you let this momentum play out, what you tend to see is, unless it's very well advertised, you tend to see the Q3 in particular rally quite a bit, and then the rest of the forward curve be dragged up. So Q4, Q1, calendar 26, these kind of contracts in the same product. So diesel, like you say, fuel. And if they get dragged up to abnormally high levels seasonally, and it was only really because, you can see it was on the basis of the prompt strength, and you've got a long-term bear view, that's the time to put the trade on. And to do it before then would be risky, not stupid, but I just think that it looks more and more like the market isn't really prepared for these refinery outages.
Yeah.
So I can see the logic in waiting for that position. Or you could do things like buy Q3 versus Q2 or Q3 versus Q4, these kind of things.
Yeah. There was a unit outlet, Dangote as well, right? Which was a gasoline component producing.
So it's the RFCC.
An RFCC. So multiple outages, plus Mexicans buying like a ton of cargoes. So it feels like just classic timing, like going into summer positioning, and then you get the fundamentals.
And you had a wary market in gasoline. Like people were, it's a bit high. RBOB's very high relative to crude, and people don't want to get caught again, like I think they did last year, which is the perfect time to be long. Because if everyone's
100%.
Cautious, that means
because that was the issue last year, was that the capacity, the financial market was so kind of peak capacity without anything to go with it. It was just kind of relying on the momentum, but like everyone.
Well, let's bring it back to the hedge funds. This is what they do that hurts markets. They've come in and they try and they do compete for the same liquidity everyone's after. And if they're so obviously in the market to be long, and everyone already wants to be long, who are they buying off? They've got to buy off the hedging liquidity that's already being absorbed. Like the market already factors in the amount of hedging. Like you have that price discovery, hedging volume, speculative volume, and it kind of balances out. When you bring in new speculative volume and no hedging volume, it just causes mayhem, a very difficult environment to trade. And it can work the other way. Like when shale oil hedging came in 2014, the market didn't know what to do with it. And actually Pierre Underon, you talked about earlier, he actually said a long time ago, look, when I'm buying now, I'm buying as I was, but now I have to accommodate for all this shale oil volume on top of it. So the balance of, it's like supply and demand for financial positions. Like the supply of positions is way higher and there's no one to absorb it. And we've said this before, gasoline is one of those markets where there are only really speculative buyers and occasional opportunistic speculative shorts. But the market dynamic is refinery hedgers who need to sell gasoline and some blending maybe, but no end user sell side hedger because buyer rather, no end user to say express themselves in the derivative market because they're not trading unless you go on Onyx Markets.
And, but that doesn't have to be the case.
Well, this is it. This is what I want people to do, right? If you've got a good enough gasoline price that relates to you, like South London pounds per litre gas price, maybe you will do it, and that's the future. But the point is, they're not in the derivative market right now to express themselves. So who can buy the hedging sell side volume? Speculators. So you have a long only market speculatively, and it just goes, corrects when this, and it's. Anyway,
and just to promo James Brody's show from Monday, he spoke a bit about how he thinks that this is going to be a pretty weak driving season. So if you
really,
yes,
interesting. And why did he say that?
The just US macros being poor. I think he's pretty pessimistic US. I don't speak for him. Watch his video. Yeah,
okay. It's a hard one though because a lot of that, I don't know where I stand because it's happened so fast that all these tariffs and all that. I understand the point that people aren't really understanding that. This has had a real impact that you won't see in the data until later on. And actually, I've spoken to James about that myself a few times, that the thing with economic data is it's very retrospective. It's not like last week, like the EIA stocks that we get in crude and products. It's 2 months prior. And then that's used as the proxy. So for example, they were saying, Chinese imported loads of oil in March. I'm like, that was like a month ago, bro. And like, honestly, that it would have been fixed a month before that. So we're talking about oil being fixed maybe last week, 2 weeks ago from China and all that. You don't wait for the data for that. You're going to like miss the move or miss the signal by a million miles.
And the one after it.
So I get the point that, we're not seeing economic weakness being factored into data and we will in a couple of months time and then the market will react. But are we actually seeing more of the prompt signals that the driving demand's weak? Because RBOB is doing very well, right?
No, I mean, we're not seeing anything yet. I think that's what's so interesting, that we are still seeing these heavy draws. But people...
draws and stocks, meaning people actually want gasoline.
Exactly. And prices...
It's not like refiners aren't buying crude and aren't refining and aren't bringing gasoline online, right?
Implied demand is decent. Like that's what is kind of driving this bullish movement. But I mean, people are still saying weak driving season, macros, people aren't going to be able to afford it. But I mean, the price of the pump will fall. That's the thing, as you said, then the end user is the buyer. That means that if there is no demand, the price of the pump should fall and kind of, generate demand in that way. But
I'm just saying the signal's not there yet.
No.
And we're getting closer and closer to summer. The sun's out, guns out. And the other thing is
and that's the most important thing.
So no, I was going to say, remember this whole like shifting change about traveling? Like there was some decent talk about how people weren't traveling to the US because of basic retaliation, doing more domestic journeys. But that's also happening in the US. They're doing more internal holidays, and they'll probably be doing more internal, which is more driving.
Yeah, that's so true.
I'm not sure. I think it's pretty speculative.
No, I'm not bearish. I'm just.
I
think
it's
slagging off Brody.
Yeah,
I would know.
let's get him in actually.
Cut it.
But also, I guess, gasoline demand in the US is probably relatively inelastic compared to some of the outages that we've got at the moment.
Yeah. I'm not trying to be rude here. I'm just looking at our group WhatsApp because I just before we came on saw someone say, ethanol waiver. Trump administration issued an emergency waiver on Monday allowing the sale of higher ethanol, E15 gasoline, to be sold this summer nationwide. This move to allow the summer sale of E15 will provide immediate relief to consumers, providing more choices at the pump and drive demand for blah, blah, blah. Okay.
Didn't we have E15? Didn't that exact same thing happen last year?
The emergency waiver will go into effect on May the 1st. Well, I don't know, but the point is that Trump administration is signaling it. What does that tell you? He's run out of bullets for now of how to weaken the oil price, which is his favorite thing to do. Okay, maybe the OPEC guys do that for him, but I think they're seeing, you asked, are OPEC seeing the signals in the market? So did the Trump administration, right? They're way more smart than they used to be. I'm 100% sure. No, I can't be 100% because I haven't physically been there, but I am very sure that the administration gets briefed on way more nuanced things now. And I reckon that is a response to strong eyeball cracks and draws and all the rest of it. What the Biden administration did in 2022, way smarter than what they've done in the past, is say, no lump sum, I'm going to go 1 million barrels per day. So when you say per day, it's drip feeding, right? And that's how we talk in OPEC terms. Oh, they're releasing an extra X amount a day or less this amount from a day. So instead of just chucking oil randomly at the market and people can store it and whatever, they've gone, no, every day you're going to get this relentless feed of oil. And they had 180 days of it, right? 180 million barrels to release into the market. That was way more intelligent. That was just to emphasize my point that I think they are way more nuanced and looking at the market in a similar way to us more and more. It's not like Trump going, price is high, bosh.
Yeah.
He might be doing that. But I'm saying the administration is thinking of these things. But what were you going to say?
I was just going to bring the actual ethanol into it because this has been kind of anticipated in a little way because there's been so much pressure from the ethanol/corn growers on Trump. Exporting ethanol and corn into Canada is absolutely huge. So where is all the ethanol going to go? Please, can we add it more to gasoline? So it's been kind of brewing for a bit. And I think it's definitely a good thing for the farmers of the US that he's doing this up in the Corn Belt.
Okay, understood. Or you think it's a reaction to that as well?
I think it's definitely considered.
But it's the fact that they said to immediate relief for summer. I think the signals are, anyway, those are the facts that as we've laid them out. I think, again, this is the theme of today. There's pretty strong bull people, there's pretty strong bear people, and you can kind of see the argument for both. But the oil market needs to materialize in the next couple of weeks on that basis. Right, so that is the gasoline. I guess your general point was people being long cracks, long time spreads, done pretty well. Do we have a graph that we can show?
So just to add a graph to that, talking about EBOB, this is the May EBOB crack, which you can see the trade houses and refiners have been adding length all through the month. And this is their gold rush there. They've made some good money here.
Yeah, understood. Okay, cool. So generally speaking, long cracks, long time spreads, long any region, you've made money. So that's a very good gold rush. Can't really argue with it. Okay, now let's move to where people have lost money. This is the Widowmaker. Okay, so I guess we said it was kind of lukewarm. The heat's dissipating out of it. So I don't think a huge amount of money has been made or lost in the outrights and all that. But the gasoline market we just talked about is kind of like a, oil traders long, they tend to be long gasoline if they're looking at it on a macro basis. That makes sense. But I guess for losing, we have to be a bit more nuanced, right? So yes. What kind of contract are you?
Well, talking to the officials boys yesterday, they explained this massive drop in the physical Dubai, and obviously that's not really a tradable contract. But looking at something that is a tradable contract is the BALMO current month, BALMO short for balance of the month, Brent Dubai differential. So this is more reactive to the physical than anything further down the curve, as it is the very, very front of the curve. And you can see this has rallied considerably. I mean, today it's up 50 cents. This is rallying a lot, and people have been short in this. So I can see this being a bit of a widowmaker for some.
I couldn't agree more. I think one, you can tell from the price action, right? When you see such straight lines, you have to have people caught there and people clambering over to buy, literally no offers, or if there is an offer, it's lifted and everyone bids on and it just goes up and up and up like that. And in more orderly rallies, you get, quite.
It looks like a distressed market.
It's a distressed market. Yeah. We've seen this in fuel earlier and all that. So this is a classic widowmaker profile.
Yeah.
I like that you focused on the BALMO. So again, to go back over that, taking things into pricing is a big thing in this market, right? If you take things into when the actual month it settles, so April contract in April, that's now going to settle a combination of the derivative market and physical tenders. So the physical kind of has its influence. So you can comfortably hold this position if you really have a good idea of what's going on in the physical, which obviously the trade houses in the industry tend to know. So what's been happening is, we have had a state of huge cuts by OPEC and everyone knows it. So the Brent Dubai has to weaken. The problem is that gets priced in quite quick. What does priced in mean? Everyone who can sell has done. Everyone who's going to sell on a bearish view has done. So then you get a situation where the market is at these low levels, but then there's still going to be buy side hedging. So when everyone's short and you get buying coming in for legitimate hedging reasons, then you get blips, right? The market can't sell anymore, so it rallies. There might be a bit of stopping out, and then it comes back down. So the safest trade, if you like, for the trade houses, or at least probably the best trade for them has been for years, is to wait for these rallies. We'll hold a structural short position and carry that into expiry. Because when you get these rallies, they can sell more, knowing with confidence that when it actually gets to the month pricing, all that hedging flow and speculative, stuff that avoids pricing will be out of the market. And then it will start to align to the physical, which they have control over, or at least a lot more information over. So it tends to roll down, right? You'll go to -1 or even flat, and then basically hold it to expiry and bonk, can go down to 250. And that roll down trade, as people like to say, you'd hold it and just let it expire, sell the net contract, hold it, let it expire, has been a very good one. So it makes sense that if you don't know when it's going to happen, you probably think, I've been making quite a lot of money on this trade, I'm going to keep it on. If things do change in Brent Dubai, I'm not going to panic, because I can start to buy all the back end, and I can to some extent protect what I've got. And just remember, this Balmo has been pricing a lot already, and Vitol came in early on in the year and bought in a huge amount of oil in Dubai, which would have helped the Brent Dubai be weak. So they probably don't care. This rally we're seeing is like not that much the month of the month left. You're talking about like 10 days of this contract max that it's been rallying. They're probably like, whatever, and now they can start concentrate on saying, right, we've genuinely structurally changed. Let's start buying everything else. And what we're seeing is people buying every other contract down the Brent Dubai curve. So the prompt Brent Dubai rallying, look, for some, it's going to be horrible. But for those who hold things longer term and see things more like as a portfolio, they're just going to be like, whatever. And that's it, really.
Yeah, like like you win some, you lose some kind of thing.
Well, if you play the odds, they've won 99%.
They're massively up. Yeah.
So that's how I would look at it. So it's a good one to point out. I just don't know how many people lost money on it, to be honest. Maybe some like opportunistic people who prop firms who don't have physical things like that. They're probably looking at it as a high percentage pattern trade of suddenly being caught out, quite possibly.
So very, very short term widowmaker.
Yeah, exactly. Yeah. But more the widowmaker, in my opinion, would have been those who've been short the rest of the curve, expecting this to continue, because now they actually going to be holding reasonable volume if they don't hold the physical, right? This is where they try and make the money before pricing, and they've had to stop out. And this rally we've got now looks pretty powerful and looks like it's not going to stop. And the sentiment is building up. It's got momentum. So yeah, that's a good one. All right, let's do the deep dive. Okay, just digging down into one particular position to get our data involved and our kind of analysis. Martha, what are we doing?
So going on what we were saying earlier about gasoline and the strength, we can see this reflected in our commitment of traders data at Onyx, and that as well as we've seen, as we've shown earlier in Europe, lots of people making a lot of money. We've also seen some players having to kind of close positions in the wake of this better strength. Right. So we can see open interest flatten and then drop here, which is the light blue line, as opposed to the dark blue line, which is the 5-year average.
This is the Singapore contract.
So yeah, this is the Sing 92 May contract. So forward looking, we'd look at June, but because this is backwards looking, we'll keep looking at May. And we didn't see that open interest keeping up into the end of the month. Net positioning has been increasing, which matches price, and we've seen pretty strong buying. But looking at counterparty positioning, we can see that this has been quite a lot due to short positioning, short covering from trade houses.
Which kind of makes sense given the sort of narrative changing, like the backdrop changing with the refinery outages, like especially with Mexico buying like multiple cargoes from Asia, so completely changing the supply and demand balance there.
I think what you got to remember as well with trade houses is, we tend to think they hold big speculative positions, but probably most of what they're doing is hedging, whether that's moving cargoes around or refiners, right? They're refiners. And we saw a fair amount of stopping out from a major or majors, both ways actually this year. Our gasoline's been on a bit of a wild ride. But as we've been saying, there's basically decent confirmation that no, we actually do have a very strong out and out gasoline market. So once that kind of, if anything, that in particular, that graph, a kind of more niche gasoline contract in Singapore of what risk there was there, that's been closed out on the short side. That's a great indication the market's gone fine. This is actually quite bullish. We're going to start believing in it. So if anything, I think you showed on that graph as well, there's been a volatility spike.
Yes.
That makes a lot of sense to me as well. When you see a volatility spike, that is the market kind of either stopping out or kind of getting some momentum behind a story. And that is undeniably bullish. Yeah, it's a pretty decent spike there. So we should now see a breakout. It's a breakout volatility. It's a breakout in the trend. It's a pretty good one to get on the back of into summer now. But you are, I guess, as much as we've said open interest on this contract's dying out, and open interest wasn't huge in the Q3 EBOB crack, I would say we're going to get there pretty quick. And you need to be a little bit careful if you're jumping on now, I would say.
Just another interesting thing you can see from our data is that there was actually some refiner buying in the contract, which is unusual as they are naturally sell side.
Yeah.
So this could be indicative of them foreseeing stronger price action coming, maybe
Absolutely.
a little bit
Reversing
unwinding of some hedges.
Yeah.
So that's another interesting point here as well, which could anticipate greater strength.
Well, also refinery outages, because if they've got a sell side hedge on, that is to account for forward production of physical. If you're no longer producing that physical, then there's no point having the hedge. So they have to buy back their hedge. Otherwise, they're actually not doing their job.
Overhedged, yeah.
They're overhedged or hedging when they shouldn't be. I mean, the same thing happened to airlines in COVID. They had these huge buy side hedges on, but the assumption is because you're always going to be periodically buying jet fuel. If suddenly you can't fly, you're not going to be buying the physical. You've got a hedge position that's now a spec position. You've got to close it out. It's a disaster scenario, to be honest.
Yeah, it's ugly.
Yeah.
But yeah, it makes sense to be seeing that, and it is good confirmation that narrative can be shifting when refiners start buying, especially in the summer. Yeah, those guys are kind of front line on where the margins are. So, yeah.
But I just can't get it off my mind to see. Okay, $8 is a bit of an arbitrary figure for our refinery margins because it's based on our benchmark. But seeing that rally to just really strong levels, and gasoline being so strong, like. Okay, 2022 again, we had $40 on gasol versus Brent at one point, and we had $40 on gasoline, $80 in the meat and the majority of what's produced by a crude barrel. One had to give, and finally the gasoline versus heating oil, I think a lot of people started selling that, and it went a lot lower. When you have refinery products all lined up with their levels versus crude, and they're all strong, at some point something has to give. And again, if OPEC are the ones producing more oil, gasoline's the one that's really strong, you would think people are going to produce a lot more gasoline and more light sweet crude. Okay, you could think that. Or you could think OPEC are going to bring back a lot more oil. Refineries are going to be running as fast as they can, given how much money they're making. What is the excess going to be that the industry doesn't need? Sorry, the end users don't need. I don't know, but I would have thought it's the shipping fuel and the diesel if you're in a recessionary mode, right? So that to me, at some point, something's got to give here. And I wouldn't want to be on the side of short gasoline. I would be, if it was a light versus heavy, as the industry likes to say. So that's gasoline, LPG, naphtha, like that's the light molecules versus diesel fuel, shipping fuel. People like to trade the two kind of baskets against each other. I think you're buying light versus heavy right now. It's the same argument for saying buying Brent to buy, really.
Yeah,
it's another proxy.
Makes sense.
So buying gasoline versus heating oil, arbor versus heating oil. We talked about that last week. That being a hedge fund trade still
feels like it's a good trade. Yeah.
And if for nothing else, there's the short side of diesel rather than the long side. But then if everyone piles in, it then becomes positionally quite dangerous.
Yeah, it does. But still, just from a kind of top line perspective, like you'd much rather have that trade on. Yeah, I don't think short gasoline. I think I'd much rather be short high sulfur fuel or something like that.
Cool. All right. Well, now let's talk about going forward. And this is the crystal ball. Okay, we've been doing the Onyx beta for a while now, all these podcasts. So now we're in the 6th week or 5th week. This, I wanted to go over, we are saying an up or down view on Brent futures, the Brent front time spread, EBOB crack, European gasoline versus Brent, and the Asia kind of shipping fuel, low sulfur fuel versus Brent. Those are our proxies for is the market bullish or bearish? And we've scored it, right? +1 for it. We got it right and we all do it, and -1 for if you get it wrong. So we've got the results on that to kind of keep track of our chat.
I didn't know we were doing negative marking.
Well, I didn't originally, and then I got told to.
A little bit suspect from Martha on the scoring there.
Yeah.
But yeah, not bad win-loss. The problem with saying up, down on iGrade is, yeah, you got to execute that, right? And you got to put the trade on. And it's always like, oh, when did you put the trade on and all that? So we're going to get more formal with this. You know, if we say it on the podcast, I think we should say, to be fair to everyone, by the time it's released, we'll do it the next day in the morning and all at the same point.
Right.
And then you have to exit at the same point the morning of the podcast. Let's say that. And then that could get a bit more precise, and then we'll see.
I'll bear that in mind when I'm marking it.
Yeah, exactly. But yeah, these things are quite cool because I guess, you know, if you need a proxy for how the market's doing right now, you're just going to look at the outright price, crude futures. But that's not enough. You got to look at the different structures, and you can weight it on that basis. And we're going to get in all these indexing. But the point is, we've been doing quite well. It's just generally been a bullish market. We've generally followed that mentality.
Yeah.
Now is interesting. So what do we think in the Brent futures?
I don't really want to.
It's a coin flip. It's a coin flip.
It is a bit of a coin flip. And the thing is, there's quite a lot to happen between now and...
Can we get in the technical charts?
Yeah, so this is just, I know we're looking forward, but this is just looking at the current M1.
Yeah.
We've seen pretty decent resistance come in, trending with this orange line, which is the 20-day moving average. So it's had a bit of trouble getting past that. The dotted line is 70, which seems pretty lofty right now, to be honest. But it wasn't when I drew it. And you can see the buying momentum, as you can see here in the MACD histogram, is becoming, there's less strong buying momentum day on day. So that's, I mean, it's not bearish yet. It's just less bullish in this indicator.
It's very prudent to look at technicals right now. Whenever you've got a lack of certainty, a lack of big players with high conviction, things are going to move more on whoever's dictating flow. The people with the highest conviction are going to be the technical traders because they've got not arbitrary. They've got signals that sit outside the physical and all that they're going to be reacting to. So they can remain active whilst everyone else isn't. So it makes sense for them to be driving the market right now. So it also makes sense for the 200-day average to be a kind of resistance point.
20-day.
Sorry?
20-day.
Sorry,
We're
20-day. And 200-day is the blue line, yeah?
No, that's 30. We're way off 200, I don't think. I'll get it up though.
I just think, because this is on a week basis and we're going to have the OPEC meeting on Monday, I think on balance of probabilities, with the Brent being as strong as I think it will be, I just think, sake, I actually don't know. I can talk both ways, and I'm like literally hearing myself do it. But I think I'm going to go with the resistance point and with the fact that we've had a pretty meaningful rally, and it just doesn't seem to want to be there. And I think OPEC have got that. They've got a mandate to want to produce more. It just does feel that way. So I can't see an out and out rally. But I will caveat that with what I've been saying about CTAs, right? I mean, I very much thought that was going to be a huge bullish factor. I think it will be on the bullish factor. The Brent expiry will be a bullish factor on the day tomorrow. But whether that follows through and the CTAs get back online, it's like a bit of a tail thing to happen. So that's my view, basically bearish. But I can see the argument if we break out, which by the way, we had at the beginning of these podcasts, we said if it starts to break out, I think it was the 200-day moving average at the time, there's a few reasons for the CTAs to catch on top of that and it to really move. So I would see it as a tail option, but I'm going to go bearish. You guys?
Yeah, I was going to say, I think just because of the timing.
It's bullish.
I think this week we probably will tick higher, but I just feel like on Monday there's going to be some announcements and everything's just going to get wiped out. So I think like week on week it's going to be lower. So yeah.
Okay. Geek in the seat.
Well, I would say week on week lower, looking at the technicals, and just kind of we're down past 65 now. People, nice level to sell out before it gets to the nice levels to buy at in the low 60s. If you've gone to my head, I'll say I'm bullish, but I'm not.
No, I'm joking. That's fine. Okay, you're bearish as well. The time spread. Now, M1, M2, I think because it's expiring tomorrow, the M1, M2 we'll look at is July, August, right? Okay. That's been under pressure quite considerably with flat price. And I think now it's getting to the point where it's too much. You saw the front fly. So front fly is M1, M2, the front time spread minus the next time spread. And it's a good indication of like relative value. Like one's more prompt than the other, obviously. So if prompt is strong and the second time spread is uncertain because it's in the future, it makes sense that the M1, M2 would way outperform the M2, M3. So the fly has gone up like 50 cents, which is very, very, very strong for a fly, the difference between one time spread and the other. So I would say that's been kind of made very undervalued. The refinery margins are too strong. Spot market is too strong. I think expiry is going to be strong on a physical basis. It's got to catch up. And I still think flat price can weaken with time spreads catching up. It's what we've had this last 6 weeks. So I'm going to go bullish the time spread. Martha, do you want to put any technicals on that?
No, I think the trouble with looking at the second, it is soon to be the prompt spread, is that it's just looks quite sideways when you zoom out a lot. But you can see we're in pretty decent volatility here.
Yeah,
we've broken down past the moving averages, and we're in the lower half. We have been kind of range trading between the Bollinger Band, so it seems like there could be some buying coming in at like minus 35, minus 30.
Yeah, but this is what I'm saying, right? So you've got, what's that level? It's at 30 cents. It's kind of like roughly the bottom of the recent longer term trend over the last 6 weeks.
Yeah, it was support level all in February as well.
Yeah, but like we're getting not that far away from that. I mean, it's still in the 40s, and it's getting closer and closer. And we're in a more bullish market, crude wise.
Yeah,
and I think that's got actually maybe the trade of the funds and the trade houses has been that, right? They've been selling this next month's spread whilst being long the front and with high conviction, and that as a kind of hedge, because it just looks to me like it's still crashing now. That is undervalued, or at least that is something's going on there that I just don't think makes sense, unless you've taken a big view on the OPEC. Again, people know things we don't, but I still don't get it, because the refining margins are so strong and they have to go first. So I have to be bullish that time spread.
Margins are strong, and I feel like that's going to translate to the Brent spreads being higher.
Okay, so me and Harry bullish. I think Martha's bearish on the technical basis. On the two.
That's what I always said.
Do you think bullish as well?
You're gonna straw man me. Yeah, I was saying bearish so we can get to the bottom of the range.
Oh, you are bearish?
Yeah.
Okay. And the two refinery cracks as our proxy. So we just talked a lot about gasoline. Very hard to be short.
Yeah. Remain bullish gasoline.
Remain bullish. I just think we're getting into danger zone. Okay. The beginning of the danger zone, let's call it, where things start to be oversaturated. Everyone's lined up to be like, yep, we're going up. But having said that, gasoline market is used to that, right? That is a market that can historically sustain bull rallies. And given how unexpected it's been up to this point, analysts getting it all wrong on the downside, I think we can say that's bull. That's fair.
Because levels are so high and we do see that monthly rollover gap, it's kind of sometimes a bit hard to be looking at EBOB technicals right now, but we can see it's been supported above the 9-day and it's well above the 30-day. We've seen a pretty strong, the stronger it moves away from the moving averages, the stronger trend it is, and the more potential there is for people to say, oh, maybe it's overbought, but I don't know if we're really seeing those levels yet. We've got momentum is strong and improving day on day as well. So that's bullish. Looking at this is bullish.
I completely agree. So okay, well, what can we look out? Let's try and add some value here, right? What are we pointing people to be careful? I would say a flat price rally. If we've called it wrong and the flat price rallies a lot, that's going to eat into demand, because the crude futures go up, the differential from gasoline to Brent is going up. That means the gasoline outright price has gone up sky high. And at some point that hurts people's demand. And people start talking about inflation again, and the Trump administration starts reacting. So I think we're not that far from that. And I think psychologically a 70 level is not what Trump wants to see. And he's already putting out stuff. So I would say high flat price is a bit of danger. Don't be too long if we're wrong on flat price and flat price is running. That's a generally good sign. Can we get up the open interest? So let's, if we go like August open interest for let's say European gasoline versus Brent, that would be interesting. Okay, so this is the open interest for
high but stagnant, I'd say.
The last 6 months, just for August, yeah?
Yes.
And the teal line, is it?
The light line is the open interest. The flat dark line is the 5-year average.
Okay, so we are above that, but we're not massively, right? No. And orange is the kind of danger zone where just an outright level, that's kind of the highs. We're nowhere near that either. So we're okay.
Yeah, and it's such fundamental. We've seen the fundamental flow of kind of refiners selling gas snap, which is selling gasoline, buying naphtha, which we see as a signal of them actually physically producing. So, like, we're going to see that come online soon, but that's also something that people are keeping an eye on as like a genuine sign of demand that this is real physical fundamental strength, not just financial strength.
Yeah. All right, finally, the VLSFO crack. I was thinking about it. I think we should change this to the Sing distillates crack to be a bit more like of a proxy of that. But let's just keep on for VLSFO this week, and we'll change it to distillates next week. But can we get the graph up for that?
Yeah, of course. So this is the prompt Sing 0.5 crack for this week. We've seen volatility keep pretty high. We've seen prices gap up and remain high, supported above $10 a barrel, breaking above the 100-day moving average and being supported up there.
This is the one that surprised me to some extent. I mean, we have been bullish here on the beta, kind of generically talking about a bull market, but now we're getting to this and distillates just not making a huge amount of sense. I mean, again, it's like what you said about gasoline driving, right? The macro people are talking about recessions. They're talking about bearish demand. This is a proxy of shipping fuel demand, right? And if shipping fuel prices are getting higher and it's on a big bull run, despite prices, outright prices being higher, that's no indication that shipping's slowing down. There's no indication.
No, we've seen support in the windows for the Sing 0.5. We've seen this being bought by physical players.
It's just not adding up, this recession talk, at least from an oil basis. And that's why it's such a good proxy for the economic situation. But having said that, you know, I guess technically you're saying it's on the breakout, but this is the one I would prefer to be bearish on, because something has got to give in this existing market we're in. That's my only real insight into it. What about you guys?
Yeah, it's a bit of a tough one. I think just on like a momentum basis, it feels like it's moving up, but
we have had higher freight prices. There's more shipping activity, which indicates more shipping demand and all that. So it would make sense for the rally and the talk, but this is about looking forward.
I think if it's short term, I probably would err on the bullish side, especially if I think flat price is going to be lower. But I think the same with gasoline. I think if you've got a flat price rally, that would really eat into VLSFO demand.
Got it. Martha?
I mean, it's hard. These levels seem pretty stable here, but if they were to dip, it might want to fill this gap here, which is what we often see in technical analysis. So I'll just be different. I'll be bearish.
Okay. Well, look, that's a good summary of where we're seeing things. I think the standout trade is the Brent Dubai. I think we talked about that a few times. We're going to do a separate video on structuring this trade. So please keep in touch for that on our channel, and that'll be out there very soon. But otherwise, guys, anything else to say? Good luck.
Yeah, well, and if you want to trade these contracts that we've been talking about, like we've been saying, that, you know, Onyx Markets is offering these uncorrelated assets where you can express views on, you know, what's going on in the market. If you want to participate in the OPEC news, if you want to participate in just some of the recession news that we've been talking about, and get access to these kind of better ways of trading.
I also think with the research team, Martha, you know, people can reach out to you guys, right? There's a lot, you're very active.
Yeah, I mean, we're on Twitter if you want to get us. I guess we'll be in the bio of the description of the episode. But yeah, if you ask us any questions, we often live tweet expiry, which is helpful. And just seeing the bulk positioning of net positioning coming into the OPEC decision for CTAs, will be just keeping that as free and as open as possible.
Okay, so that's Onyx Edge, is it? Onyx
underscore Edge.
That's on X.
I'm Martha underscore Onyx.
Okay. And then you've got Flux.live for loads of articles that they're pumping out, information, data, all free. Go and check that out, and check out the Flux platform as well. But either way, guys, thanks very much for listening. Hopefully see you again next week for more.